Welcome back to The Explainer. Today, we're taking all that classification and onboarding infrastructure we built in previous sections, and we're plugging it directly into the operational engine of recurring payroll. Now, you might be wondering why we're focusing so heavily on this. Well, it's because this is where your day-to-day compliance exposure truly lives. Running payroll isn't just mashing a button and hoping for the best. It's a remarkably rigid process. It has to be executed in the exact same sequence every single time. And as you'll see, every step, from that initial time capture all the way through to benefits remittance, carries a strict deadline, a mandatory control, and some pretty serious consequences if you fail.
So let's dive right into this high-stakes assembly line. We've got 5 main stations on our agenda today. Station 1 is time and attendance. Station 2 is the calculation engine. Station 3 covers our safety gates. Station 4 is disbursements and tax deposits. And we'll wrap up at Station 5 with benefits and administration. Every single one of these steps must be completed in order before a single dime goes out the door.
All right, Station 1, time and attendance. Let's get right into it. Our very first stop is time capture. For non-exempt employees, the Fair Labor Standards Act is incredibly clear. They have to be paid 1.5 times their regular rate for federal overtime when they cross that 40-hour mark in a week. And listen, every single hour has to be captured because the obligation to pay absolutely exists, even if the work wasn't authorized. Seriously, if an employee works through lunch without asking, yeah, you still owe them the money. Also, if they take time off for a medical reason, you have to properly track and designate that time under the Family and Medical Leave Act, right here at the capture stage, to protect both their job and the company's liability. Now, contrast that with contractors. We track them strictly by deliverables. Why? To avoid behavioral control. If you start making a contractor clock in to your internal time system or mandate their daily hours, you're going to destroy their independent classification entirely. Moving right along to Station 2, the calculation engine. Let's look at how those hours actually turn into dollars. So the system pulls in a bunch of complex components for every active employee. We always kick things off with gross pay. That's your base, overtime, bonuses, and commissions. Then we immediately apply Section 125 pre-tax deductions. Think 401k deferrals, health, dental, and vision premiums, plus any FSA or HSA elections. These are super important because they knock down both federal and state taxable income right out of the gate. But wait, we're not done. After taxes are calculated, we have to hit the post-tax deductions. This is where you see the really strict mandatory stuff, like wage garnishments for child support or tax levies, along with state-specific hits like state disability insurance and paid family leave.
Now, take a look at this table. The big takeaway here is that employee and employer side taxes are running simultaneously. For the employee, we pull Social Security at 6.2% on wages up to the 2023 wage base of $160,200 and Medicare at 1.45%. Plus, there's an additional Medicare tax of 0.9% on wages over $200,000. While that's happening, the employer is paying matching FICA taxes on their end, plus FUTA at 6% on the first $7,000 for each employee. And a quick reality check here. Absolutely never run your independent contractors through the system. If you do, you instantly trigger employment tax obligations that nobody intended, and you create a massive, messy tax correction burden.
Next up, Station 3, the safety gates. Because before we actually pay anyone, this calculation engine feeds directly into our mandatory controls. We have to pass through these 5 absolutely rigid gates. First is the variance check, where we compare total payroll to the prior period to hunt for anomalies. Then the headcount check, making sure our numbers perfectly match the active HR list so no ghost employees get paid. Third is the new employee check, to confirm all onboarding and tax forms are completely locked in. Fourth, the termination check, ensuring no former employees somehow snuck into the run. And finally, the minimum wage check. This makes sure nobody's effective hourly rate dipped below federal or state minimums, which is especially critical for tipped workers or piece rate employees. Let me paint a picture for you. Imagine your variance check suddenly shows a 12% spike compared to the last pay period, and literally nobody can explain why. What do? You halt the assembly line immediately. Pushing it through and saying, we'll look into it later, is a massive compliance failure. You have to trace and document every single change before moving forward. An unexplained increase isn't just a red flag, it's a full stop. Okay, so once everything checks out and the finance director gives their formal written approval, the register is locked. That's it. No more changes to this payroll run. At this exact point, we generate compliant, state-specific payslips. This is a surprisingly huge compliance area since different states dictate down to the letter what has to appear on that stub. And just to reiterate, contractor payments are nowhere near this locked register. They are reviewed completely separately and paid through accounts payable.
Which brings us to Station 4, disbursements and tax deposits. With the register locked, we've reached the climax of the process.
To keep our duties properly segregated, the Treasury Department, not your payroll preparer, is the one actually submitting the ACH file to the bank. Meanwhile, we have to make our federal tax deposits through the electronic federal tax payment system, and the timeline here is totally dependent on your liability size. Monthly depositors have until the 15th of the following month. Semi-weekly depositors get 3 to 4 business days. But watch out for the next day rule. If a single payroll's tax liability clears $100,000, you have exactly 1 day. Things accelerate incredibly fast for large payrolls.
15%. You know what's really terrifying about this number? It represents the absolute maximum penalty for late payroll tax deposits. If you're just 1 to 5 days late, the penalty starts at 2%, but it scales aggressively all the way up to that 15% mark. But here's the crazy part. Standard company penalties aren't even the scariest risk in this process. We need to talk about the trust fund recovery penalty, and I really need to hit this point hard. Unpaid payroll taxes become the personal liability of responsible corporate officers. Let that sink in. The officer who signs that EFTPS authorization, whether it's the CFO or the controller, is quite literally risking their own personal bank account for potentially hundreds of thousands of dollars if those withheld taxes aren't remitted. This is not just a slap on the wrist for the company. It's a personal penalty. The IRS can and absolutely will pierce right through the corporate shield to get it.
Okay, take a breath. Let's move to our final stop. Station 5, benefits and administration. After the stress of disbursements, we enter the cleanup phase.
7. You have exactly 7 business days to remit 401k employee deferrals to the plan administrator.
And listen to me on this one. The Department of Labor 7-day rule has 0 grace period. None. And there is absolutely no materiality threshold either. Meaning if you are even 1 single day late, or the amount is literally just pennies, it triggers a prohibited transaction. Boom. Excise taxes and mandatory plan corrections. You really want to automate this remittance to fire off on the payroll processing date whenever possible so you don't get crushed by the DOL.
To officially close out the period, we handle a few last vital operations. We remit those health, dental, and vision premiums to make sure nobody's coverage lapses mid-month. We accrue the workers' compensation premium, which is just the payroll times the class rate divided by 100. We post the PTO accrual liability, so our balance sheet stays completely honest. And for employers with 50 or more workers, we track the Affordable Care Act full-time equivalent counts. Anyone working 130 hours or more in a month is considered full-time. And remember our contractors? If one of them is ever retroactively reclassified as an employee, all their past hours instantly count toward your ACA metrics, which is just a massive hidden exposure risk.
So as you can see, this payroll engine runs like a Swiss watch when we stick to these 5 stations. But here's the real world for you. What happens to the general ledger when mid-cycle changes pop up out of nowhere, or an employee suddenly separates on a Tuesday? Well, that provocative question brings us to the end of this explainer. But don't worry, it perfectly sets the stage for Section 6, where we are going to unpack exactly how all of this translates into the accounting side, and more importantly, how you handle the chaos that falls outside the regular recurring cycle. See you there.